People hear Japan is collapsing, and they imagine a single domino that takes down everything. But the more useful question is quieter: what happens to global markets when the cheapest funding source in the world stops being cheap? Today we'll talk about Japan's rates, the yen, and why a small policy shift can ripple far outside Japan. Welcome back to the Passive Path. Calm, practical money conversations, no panic, no drama. The topic: Japan's debt headlines, bond market stress, and how a stronger yen or higher Japanese rates can tighten financial conditions globally. And joining me is a guest voice for this episode, a fictional analyst character who represents the ideas we're exploring today. No credentials, no insider access, just a clear way of thinking.
Glad to be here. And yes, let's keep it grounded. If someone wants a single villain or a single switch that controls the whole world, they'll be disappointed. What we can do is map the mechanisms: debt, rates, currency, leverage, and behavior. That's where the real risk and the real opportunity to stay safe usually sits.
Let's start with the scary headline version. What are people reacting to?
Usually three things. First, Japan's government debt is very large relative to GDP, so people assume default risk. Second, when bond auctions look weak or yields jump, people translate that into Japan can't fund itself. Third, when the Bank of Japan signals policy normalization, higher rates, less bond buying, markets think, okay, something's changing. The problem is that those three facts can be real and the conclusion can still be wrong if you skip the details.
So when someone says Japan can't sell its bonds, what does that actually mean in plain English?
Most of the time it means the price investors demand is changing. A bond auction can be weak because buyers want a higher yield than the government hoped for. The bonds still sell, just at a different price, or the central bank adjusts operations in the secondary market. It's not like a family trying to refinance a mortgage and getting rejected. A sovereign that issues debt in its own currency has different tools and different constraints. The real question becomes, what are the consequences of using those tools? Inflation, currency moves, distribution effects inside the country, and credibility over time.
So is Japan going bankrupt in the way people mean it?
Bankrupt is a loaded word. Japan's situation is less about a sudden inability to pay tomorrow morning, and more about trade-offs. If a government issues debt in a currency it controls, the risk isn't usually they literally run out of yen. The risk is that maintaining stability requires choices people don't like. Higher inflation, higher taxes, spending cuts, or financial repression, like keeping real rates low. And the market risk for everyone else isn't Japan disappears. It's Japan's policy shift changes global funding and risk appetite.
Okay, that brings us to the yen and rates. Explain the link that matters to listeners.
Think of the yen as a funding currency. For years, Japan had very low interest rates. That created a behavior: borrow in yen at low cost, convert into another currency, and buy higher yielding assets like US bonds, credit, or equities. That's a carry trade. It's not one trade done by one person. It's a pattern across funds, banks, corporations, and even indirectly through hedging markets. When Japanese rates rise or when the yen strengthens, this trade becomes less attractive or more dangerous. Positions get reduced, leverage comes down, and that can create selling pressure on the assets that were funded by cheap yen.
So the Japan story isn't really just about Japan, it's about leverage.
Exactly. Global markets don't just move on growth versus recession. They also move on how easy is it to fund risk. If funding is cheap and stable, people can hold more positions. If funding costs rise or currency risk spikes, people reduce exposure. That's when correlations go to 1 and everything feels like it's sliding together.
The transcript we're drawing from connects Japan's rate hikes with past crises. Can we talk about that without turning it into a conspiracy?
We can, by using the right frame. One factor among many, but a powerful one. For example, in 2008 you had US housing leverage, complex securitization, and fragile bank balance sheets. Japan was not the core, but shifts in global funding conditions and risk appetite can amplify fragile systems. In the late 1990s Asia crisis, there were currency pegs, short-term foreign debt, and mismatched balance sheets. Capital flows mattered a lot. Japan's financial conditions and regional banking linkages were part of that ecosystem. So yes, Japan's rate environment can be a lever, but it's a lever that pulls on a machine that already has tension in it.
That's a good distinction. Lever versus root cause. Let's go practical. If someone only remembers one mechanism from this episode, what should it be?
This, when a cheap funding source becomes less cheap, leveraged positions unwind. That unwind can hit stocks, long-duration bonds, speculative assets, and even some emerging market currencies, basically anything that benefited from abundant global liquidity. And the yen often strengthens during risk-off episodes because people scramble to close yen-funded positions, buying yen to repay yen liabilities.
People hear yen strengthens and think that's only a Japan tourist story.
Right. They think my ramen is cheaper, which is real for travelers. But in markets, a strengthening yen can be a stress signal. It's like seeing more umbrellas outside. The umbrellas didn't cause the rain, but they tell you people believe rain is likely.
Now, I want to address another common claim. Japan's debt is massive, so default is inevitable. How do you answer that responsibly?
I answer it in layers. Layer 1. Debt to GDP is high. Yes, that's a fact worth respecting. Layer 2. Who holds the debt matters. Japan has historically had a large domestic investor base and significant central bank involvement. That structure changes the immediate default dynamics compared to a country borrowing heavily in a foreign currency. Layer 3. Sustainability depends on the relationship between interest costs, growth, inflation, and political willingness. If rates rise meaningfully while growth is weak, interest burden becomes a bigger budget issue. Layer 4. Even without a technical default, people can still lose purchasing power through inflation or currency depreciation. No default doesn't mean no pain. It means the pain might show up differently.
That last sentence is important. People treat default like the only bad outcome.
Exactly. In real life, governments and central banks often choose outcomes that are less dramatic but still costly for someone. Savers, wage earners, young buyers, retirees, pick your group. So the investor mindset should be, don't bet your plan on one dramatic headline. Build a plan that can handle multiple messy outcomes.
Let's make it concrete with an example.
Sure. Imagine a global fund that borrowed at near zero in yen and bought US tech stocks and long-term bonds. If Japanese rates creep up and the yen starts rising, two pressures hit at once. Funding cost rises, and currency losses appear on the liability side. Risk managers then demand less leverage. The fund sells some US assets to reduce exposure. Many funds do the same thing around the same time. Prices fall faster than fundamentals changed. That's how you get a market that feels irrational. It's not irrational. It's mechanical de-risking.
So if you're a normal person with a retirement portfolio, what does that mean?
It means volatility can spike for reasons that have nothing to do with your job, your country, or your personal finances. And the mistake people make is they interpret that volatility as a signal that they must act fast, right now, emotionally. The correct response is slower. Prepare before volatility arrives.
Preparation sounds vague. Give me a checklist that doesn't require anyone to be a macro trader.
Great. Here's a practical checklist. 1. Know your real risk. If a 25% drawdown would force you to sell, your allocation is too aggressive, no matter how diversified it looks on paper. 2. Avoid leverage. If your plan only works when financing stays cheap, it's not a plan. It's a bet on conditions. 3. Build a cash buffer, not as a prediction tool, but as a behavior tool. Cash reduces the chance you'll sell at the wrong time. 4. Be honest about duration risk. Long-term bonds can drop sharply. When yields rise, they're not automatically safe. They're safe in some environments and painful in others. 5. If you have foreign currency exposure through international investing or a business, understand it. You don't have to hedge everything, but you should know what you own.
That's solid. Now let's talk about indicators because people love having something to watch. What should listeners pay attention to without becoming doom scrollers?
I'd keep it simple. Watch Japanese government bond yields, especially the 10-year and any sudden moves across the curve. Watch the yen versus the dollar, but focus on direction and speed more than the exact number. Watch central bank communication, not the headlines, but the policy stance. Are they tightening, loosening, or shifting tools? And watch global stress gauges, credit spreads, funding market tension, and broad volatility indices. You don't need 10 dashboards. You need a few signals that tell you when the system is tightening.
The transcript also frames this as Japan raises rates, markets drop. That's clean, but maybe too clean. What's a more accurate way to say it?
I'd say a change in Japan's rates can be one contributor to a global tightening impulse. Sometimes that impulse matters a lot. Sometimes it's drowned out by other forces. U.S. growth, fiscal policy, geopolitics, tech earnings, energy prices. The reason Japan gets attention is because it's been an outlier for a long time. When a long-standing outlier moves, people reprice assumptions quickly.
Let's do some scenario thinking, but keep it realistic. Give me 3 scenarios and what they would feel like.
Scenario 1. Slow normalization. Rates in Japan rise modestly over time. The yen firms gradually, markets adjust. But there's no dramatic unwind. This looks like choppy returns, rotation in leadership, and periodic volatility spikes that fade. Scenario 2. Sharp repricing. Japan signals faster tightening or yields gap up. The yen strengthens quickly, risk assets wobble as leveraged positions reduce. This feels like a sudden correction. Why is everything down at once, and then a stabilization once positioning clears? Scenario 3. Disorderly stress. Liquidity thins out. Funding markets tighten. Moves become jumpy. In this scenario you see forced selling and policy responses, central banks stepping in, governments messaging, maybe emergency liquidity tools. For a normal household, the best response across all scenarios is the same. Don't be forced to act at the worst time.
That's the passive pathway of saying, don't build a fragile life.
Exactly. Fragility is the enemy. People focus on being right. But long-term wealth comes from staying in the game, through multiple environments, without a single event wiping you out.
I want to address another claim from the transcript, that Japan's central bank is coordinating with other powers. How do we keep the useful insight and drop the unhelpful narrative?
We keep the insight that central banks respond to global conditions, and that policy actions have spillovers, and we drop the idea that everything is centrally planned. Markets are too complex for that. A better mental model is incentives and constraints. Japan has domestic constraints: growth, inflation, debt service optics, currency competitiveness. The US has its own. Europe has its own. Sometimes actions align because constraints align. That's not a secret meeting. That's a world where everyone is reacting to similar pressures.
Good, because the point here is not to scare people into a bunker. The point is to help them stop being surprised by how connected things are.
Exactly. And once you understand the connection, you can act. Boring. Boring is good. Boring means diversified, liquid enough, no forced selling, and a plan you can follow when your feed is screaming.
Let's bring this back to the listener who's thinking, so what do I do this month?
This month, you do the unsexy work. Rebalance if you're off target. Check that your emergency fund is real. Reduce high-interest debt. Stop adding complexity to chase performance. If you invest, make sure your contributions are automated and sized, so you won't shut them off during stress. And if you're tempted to make a big macro bet, like moving everything into a currency because you think it's about to surge, pause. Currency calls are hard even for professionals.
That's important. People hear yen might strengthen and suddenly want to become a currency trader.
Exactly. You don't need to win the macro game. You need to avoid losing the personal finance game. If you want a macro-aware adjustment, keep it modest, reduce leverage, avoid concentrated bets, and understand your exposures. That's enough.
Before we close, I want to ask the human question. Why do these narratives spread so fast?
Because they offer a story that feels actionable. Japan is collapsing is a clean story. It gives the brain a villain and a deadline. It makes uncertainty feel controllable. But reality is slower and more frustrating. Policy shifts, positioning, liquidity, and second-order effects. The way you protect yourself is by choosing better questions. Not what's the next headline, but where is leverage hiding, And how fragile is my plan?
That's a good place to land. Let me summarize what we covered. Japan's debt headlines can sound catastrophic, but the more practical risk is the ripple rates in the yen changing global funding conditions. When cheap funding gets tighter, leveraged trades unwind, and that can hit assets far from Japan. The move is not panic. The move is preparation, reduce fragility, keep liquidity, avoid leverage, understand your exposures, and stay consistent.
And if I can add one last line, you don't need certainty to be ready. You just need a portfolio and a life that can tolerate surprises without forcing you into bad decisions.
Perfect. Thanks for joining us on the Passive Path.
Thanks for having me. Take care and keep it steady.